US stocks roll over after Jackson Hole as Powell kills hopes of an early Fed pivot. VIX finally catches a bid as dealer positioning flips short, with key macro data coming up over the next month. Gold gets hit on a strong dollar and higher real yields, whilst oil looks strong after OPEC talk about production cuts. All this and more in this week's Macro Insight. All right, welcome back to Macro Insight, everyone. Today is 30th of August, and let's take a look at these markets. So what did we have last week? Well, it's a bit more than a week. Obviously, I've been out on holiday for a week, so we'll look at the last couple of weeks and see what's been going on. Obviously, stocks kind of had their charge into the middle of August and topped out just before August expiry. After rejecting the 200-day moving average at 43.25, they kind of found a bit of weakness just after that expiry, which was kind of pinning it around there. There was reasonable amount of long gamma, as had been discussed with Brent at spot gamma. And as soon as that expired in the morning of that Friday OPEX, markets already kind of started melting down a bit. And then since then, obviously, the Jackson Hole event that was kind of, it seemed that certainly equities were thinking of it as a bit of a non-event, turned out to be quite a big event, right? And it took the market down over 3% last Friday as the market kind of repriced Fed expectations about the Fed and exactly what their resolve is to get inflation in check and where this pivot may or may not come. The market is kind of now in the process of digesting that and accepting the realization that despite inflation may be peaking, to really get it back down below target may require rates going, towards 4% and staying there for quite some time, which is kind of the message that Powell was giving last week. Yeah. Okay. You can see from the cross asset vol dashboard here that in terms of sigma moves on the week, we didn't really have any multi-sigma moves for a change. But obviously on Friday, we did have a big 3.5% down day on the S&P, which was, a 2 sigma move from a daily perspective. What else were we seeing going on in terms of market action? Obviously, we had rates market back up to reflect the higher expected terminal rates, 2-year yields hitting a cycle high there. But long end treasuries were, yields were higher, but they weren't going crazy, basically, right? So we're seeing continued sort of inversion of that curve as those growth concerns aren't really going to go anywhere. The dollar did strengthen back up towards recent highs, but seems to be losing some momentum as the euro seems to be holding the line at around parity. Dollar yen is retesting the highs, or was retesting the highs on the back of the yields move, but we're not seeing aggressive breakout yet from these dollar highs that we've seen over the last couple of weeks. That's not to say it might not still happen, but it hasn't happened as of yet. Commodities were a mixed bag, with grains and energy higher, but metals weaker on the stronger dollar. And then gold and silver particularly weak with higher real yields, as we often see. Credit spreads widened on the risk sentiment sell-off in anticipation of QT acceleration this month as well. And that was one of the reasons why we've gone short HYG, because we believe that market should be disproportionately impacted by QT. Whereas equities can keep, squeezing and doing whatever they want, we think credit markets will kind of have to be impacted by that dynamic. And then lastly, crypto markets sold off in line with risk, particularly with growth tech getting sold hard. Optimism around the merge was not enough to arrest the decline. And obviously, some of the people who have been playing that merge trade have probably already bailed out and taken profit. Because it's not clear necessarily that it's not going to be a buy the rumor, sell the fact type moment. Yeah. Okay. So then if we have a look at some of the stuff coming up this week, we've got consumer confidence out of the US. We've got Eurozone CPI tomorrow. US ISM manufacturing on Thursday, and then the big one will be non-farm payrolls on Friday. Obviously, with this data dependence that we've got from the Fed, and then talking about the total, all of the data needs to be taken into account to determine what they're going to do in the September meeting. Obviously, non-farms is going to matter, ISM is potentially going to matter, and obviously CPI is going to be huge, right? And CPI is coming up in a couple of weeks before that FOMC meeting. Okay, so that's what we got coming up. If we then sort of look a bit deeper into, is the Fed pivot really dead and what's been going on? And one of my main reasons for remaining bearish and not really changing my mind on that a couple of weeks ago when I talked to Brent and basically calling bullshit on the rally was that it just didn't make a lot of sense to me that after 150 basis points worth of hikes, financial conditions hadn't budged. And I didn't think Powell would be particularly pleased about that. So it seems that was probably the overriding reason why he had to give that more hawkish message in Jackson Hole. And that's what we got. And then Kashkari's come out and pretty much said, I'm glad the market sold off. It's doing what it's supposed to do, basically. Right? So they want to see stocks lower because if stocks keep ripping higher, that is counteracting what they want to happen on inflation, right? So that was my reason for kind of staying with the trade and feeling pretty comfortable about being short a bunch of calls that had gone in the money temporarily, right? Now, the market, has had a few short squeezes this year. We look at that chart there where we've got the December 22 Fed rate expectations in red, and then we've got the S&P superimposed over that. You can see that, in February, March, we had a squeeze that deviated from that trend. Then it caught back up. It happened again in May, caught back up. And then it's happening again now in July, August, and now we're on the way back down. So the equity market does keep pushing away from this downtrend or uptrend in rates, let's say. But whilst that trend is still persistent, it's just a matter of time, it seems, before the equity market then catches up with that trend and heads back down. And that's pretty similar as well to what we're seeing with regards to net liquidity, right? And we look at that net liquidity graph and we see what's happening with the balance sheet and the reverse repo and the Treasury General account. There is that trend for that to be going lower. And whilst the S&P has these moments of squeezing away from it, it often does catch back down, basically, right? And I think we're kind of likely to see that happen over the coming couple of months, right? Powell's decisive 8-minute speech obviously left markets pricing in about a 2/3 probability of a 75 bip hike in September FOMC. Terminal funds rate has now pushed out to about 3.8%. From 3.45, and it's been delayed by about 3 to 6 months, basically when they turn around and start cutting again. So even though they said that they're not going to be cutting in 2023, they're not going to be pivoting, the market is still kind of not too sure on whether they believe that, right? So whilst they've pushed back the pivot a little bit, they've still got a bit of a pivot priced into the rates market. You can see that on this graph here, and how that kind of Fed funds has kind of evolved over the last kind of month or so. Okay, so that's kind of Fed pivot. So, the pivot story isn't really dead in terms of what rates markets are pricing in, but in terms of a fast pivot happening fairly soon, that's what the market is repricing now and realizing that's not about to happen, basically, right? Even if inflation's peaked, yeah. The S&P price action over the course of the sort of week and a half, as I said, we had that rally up towards the 200 days. Pretty amazing, really, just how that was pretty much to the tick almost, that 200-day getting rejected. The market then, did pull back, chopped around a bit, kind of hung in there into that expiry as we expected. Was a little bit weaker than I would have liked, to be honest. My condor didn't end up paying out, annoyingly. I know some of you did a condor expiring a bit earlier than that, so I think you guys did better than I did on that one. But I kind of ran that one for a little bit too long because I was already very short the market as the market rallied up there. So I was like, well, if it sells off, then my shorts are going to be working anyway. So it was kind of working as a little bit of a hedge to me if the market just stayed stuck up there. But anyway, post that OPEX, as you can see, that sort of dotted green vertical line, we then got our acceleration as that long gamma exposure expired. and the market was able to kind of move more in line with what fundamentals were telling it to do, basically, right? So and as those rates expectations got priced higher, the market sold off on the back of that. Yeah. We're now down to sort of close to the 4,000 area. Looks to be quite a key level with a decent amount of open interest building up there, according to Spot Gamma and those sort of guys. But we're not really in a state of equilibrium here, right? And key macro data like non-farm payrolls and CPI is likely to have amplified impact, given that the market has now moved away from long gamma territory back towards short gamma territory, or supposedly it has. Remains to be seen, right? Depends how much volatility we're going to sustain, and that will give us a tell really on how long or short the market is. But we also know that this quarter end JP Morgan collar may be playing a part as we head towards the end of September, so a month away after FOMC. So it's probably a little bit early to call any sort of pinning impact right now for that. We know there's a big strike at the 4,005 level, which dealers are actually long. And the strike that they are short is down here at around 3,600, right? So I think the closer we get towards the end of September, if we're in the vicinity of either of those two strikes, that's when we're really going to have to pay attention to that and be aware of that strike and the impact that it's having. Right now, there's enough other stuff in front of it that's muddying the waters that I don't think we can make a really high conviction call on that kind of positioning right now and how much impact it's having. Yeah. In terms of sector performance, we saw obviously energy and metals leading the way. Everything else kind of getting beaten up. So if we go back to say like the 19th, post that expiry, we see energy up 6, metals pretty flat, everything else down, with retail and tech getting butchered, right? About 9% apiece. And even defensive sectors such as utilities, staples, healthcare, not really able to escape, right? They're in the 2 to 5% down sort of region over that sort of week and a half. Yeah. Now let's talk about the VIX, right? So if we look at the VIX, interesting last week on that sell-off on Friday, that the VIX actually got caught a bit of a bid as opposed to other asset classes, right? So in the equities bloodbath, you saw VIX go up, but you saw FX vol come down and you saw rates vol come down. Okay. And now you could argue that the other asset classes were already a bit inflated in terms of their volatility, and they were pricing in more of a move for Jackson Hole, whereas equities just wasn't. And then we got a 3% move in equities. And so, the vol needed to reflect that we got volatility that we hadn't anticipated. Whereas in those other markets, whilst you might have still got some moves, it was anticipated. So the vol needed to reset back down, basically, right? So that would be the way I would rationalize that, But, it may well also be that the VIX is now finally starting to catch up to the idea that the macro risk is increasing, right? The Fed has told us that it wants the market lower. We are going into an accelerated QT. We've got all these data points. And even if we've got peak inflation, that may well not be enough to stop the Fed hiking, right? So macro risk is going up. And then you throw into that the seasonality of the VIX, where here you see generally September and October, you see VIX higher, and then it sells off again into Christmas. But typically September or October are good months to own vol, right? So all of these may be reasons why the VIX is starting to perform, right? And some buying has been coming in, right? We thought 18 to 20 was going to be a good floor on the VIX. Whilst I didn't chase the VIX because the roll yields were quite high, I didn't think the VIX spot was going to smash through 20. And I mentioned that once the 1 month window that the VIX calculation uses, once that captures all of these events like FOMC, it was gonna drift higher. So rather than the futures rolling down to spot, there was certainly a chance that the spot was going to roll up towards the futures. And that's basically what we've seen happen, right? We've got NFP, CPI, and FOMC all within that 1 month bucket. So don't expect that VIX spot to get annihilated until some of those events pass, basically, right? That's kind of what we're looking at there. And then that VIX beta, right? So you look here, you've got the S&P chart and you've got the VIX inverted. And generally, they've kind of been tracking each other. And the VIX, if anything, the VIX, had been struggling to perform when the S&P was going down. But now you had that down move in the S&P and the VIX has got, the VIX has spiked reasonably well. So the VIX beta, and this is something that obviously I track on my dashboard here. So this VIX beta signal, you can see here that we've got the short dated VIX beta has ticked up to 2.9, right? So it had got onto a one handle, right? And so that orange line moving south is basically the short-term VIX beta picking up and going actually above. I say above because it's inverted, right? So it's basically the VIX becoming more sensitive in the last 1 month sample than it has been in the last 3 month sample, right? So, I was looking for that VIX beta to start to pick up basically, right? And we're getting that coincident with a spike in VIX. Okay, the roll yield has now gone all the way back down to around 3.8% from 10%. 10% kind of felt like it was unsustainable, but it was just a question of how quickly was that going to go away. I wasn't trying to call the timing on that. But then, the other thing I've noticed is there's a reasonable amount of open interest building up in the VIX complex in terms of options, where people have been selling the October 20 strike to be buying the upside, right? Buying like the 50 strike calls. So there was a decent hedge risk reversal trade, buying VIX calls, selling puts that went up a week or two ago in decent size, about 160,000 lots in the VIX. And that basically is some positioning where people are trying to lean on saying that the VIX is floored at 20 and we've got midterms coming up as well. So even after the FOMC goes, you've still got that VIX bucket, that October VIX contract is going to capture the midterms, right? So if the market anticipates some movement on midterms, that might prevent the VIX from going below 20. So people are leaning on that idea to fund protection by owning the 50 calls on the VIX in October, right? And that's where we see this open interest landscape. So whilst we might have fairly uniform landscape in terms of September, we've got quite a major pillars at either end, where you've got the short puts here on the 20 strike and we've got the long 50 strike. This is the client side, right? On those. And then even higher strikes above that in the kind of 70 region. People have been going far out to November and October, the way upside stuff as proper crash risk. But I thought that trade was probably the most interesting trade on VIX that I'd seen in recent times. And then the last chart I would just mention here is from Tier 1 Alpha again, is, for a down 3.5% move in S&P, the level that we're seeing in the VIX is pretty low, right? And now that we're in short gamma, or supposedly short GEX territory, negative GEX territory, right? So the street is short gamma. You would typically expect to see higher levels of VIX for those type of down moves, right? So, we haven't seen it yet. Personally, I feel like 3,600 is going to be a big inflection level, right? So whilst around here, around 4,000, 38 to 4,000, I still don't see the VIX going mental, right? If the market stays weak. But if we start to test 3,600 again and take out the low and we enter new territory, that's when I could actually see VIX going here in the 40 to 50 area and some of those October VIX calls actually coming into play and creating a bit of a self-fulfilling dynamic where dealers are forced to cover vol and buy stuff against that, right? The reality is we may well see the person who bought that come and sell those VIX calls, because if you do buy VIX calls and they work, you have about a window of 6 hours to sell them. Otherwise, you often lose all your money. So that may well happen as well. But just bear in mind that, VIX probably underperform, even though the VIX is starting to pick up beta on the sell-off, it's probably still underperforming really what it should have done for a down 3.5% day. And I think some of that might be due to the fact that dealers have got a bit of vol in those 4,000 strikes end of those JP Morgan end of September strikes. If we move away from that down towards that 3,600 area where dealers are actually short that strike to JP Morgan, then we might see some real shenanigans, right? And we might see some real bid to volatility. So that's what I'll be kind of looking for. Yeah. So we zoom out here, we had these pretty long-term uptrend supports, and it kind of held nicely around near that $85 area, basically, right? So uptrend seems to be intact. There was a lot of bearish news flow that was hitting the tape. Prices managed to hang in there. Longer term uptrend is intact, okay? We already mentioned what happened in terms of OPEC and what they said regarding production cuts. But then, we had large inventory drawdowns as well. SPR reserve releases are due to stop in October, I believe. So that's supportive going forward. If they're going to stop supplying all those barrels. And then we've also got some supply issues that came out of Kazakhstan and Libya recently. Okay, so the picture may be starting to turn a little bit in oil, right? If you look at where implied vols are in oil, there's still a bit of positive carry there, right? So it's not clear. If you are bullish oil, if you think we are starting to turn and we could head back towards the highs, buying outright calls looks pretty expensive, okay? So if I bring up the vol dashboard on oil, we can see that in USO, for example, vols are kind of mid-range to slightly expensive, at around 43 in the 1 month, but the carry is positive 13.5 vols, and it's in the 75th percentile, right? So it's not real. The realized isn't justifying those implied levels. It's just that people are a bit scared to short oil vol, basically, right? So that's why it kind of stays relatively expensive. If you are looking to use options to play a bullish directional view, call spreads are kind of probably the preferred expression, right? You could try a bullish risk. I mean, even though the mean reversion obviously suggests bearish riskies because it thinks that spot is toppy, if you're bullish and looking for a breakout, and the fact that we do have put skew in the order of magnitude of about 4 vols in the 1 month, selling puts to buy calls to play that move, it's a brave one because you've got unlimited downside if it sells off, but that can make sense in the short term. I prefer the safer expression of just buying a call spread and spending a little bit of premium, buying yourself maybe 3 months, going out to November or something like that. So a November call spread, I was looking on USO, November call spread, USO is trading at around 79. If you bought something like an 85, 95 call spread, top strike is like 20% away in 3 months' time. If you think that's the type of upside we could get in oil, then you're getting about 4-to-1 payout on that, right? You pay roughly $2 and a bit to make nearly $8 on that call spread. To me, that looks like a much safer, more sensible way to express your long on oil, given the higher levels of vol and the fact that just selling a load of downside puts probably a bit dangerous, right? Because oil, when it wants to move, it knows how to move, right? So that's how I would kind of play that. Okay, and then the last thing I want to talk about in terms of the macro is the gold smackdown, right? So I had flagged last time that gold vols were looking cheap. If you wanted to fade this move, buying puts made sense. 1800 was a bit of a resistance. That seemed to play out pretty well. We've now come off from that level back down to the lower Bollinger. We're not quite at the 1680 level in terms of spot. That's where the market has just bounced. I've lost count of how many times. It's a massive support level, 1680. We're not there. We're about 1730 odd now. So we've got a bit of room to go still. If you were lucky enough to own some puts in gold, you haven't really got a big vol spike because the realized has been too orderly, right? So you look at the carry, you're seeing a 5 vol positive 80th percentile, showing you that whilst we have come off from 1800, we haven't done it in a violent fashion. So vol hasn't really spiked. So you can see here, vol did base at around 12, 13, but it's sitting there at about 15 and it's not really got going, basically, right? You would have needed a bit more of a violent move to really get that going, okay? The thing that has happened, though, is that skew has flipped from calls towards puts. So like a month ago, the skew was more for calls on gold as we were trying to break up, and now it's flipped back towards puts as people are like looking to the downside. If you're losing conviction on this trade or you want to bank a little bit of money, if you are long puts, a decent risk management trade might be to sell some lower strike puts out to bank some of that more expensive skew that's come, and the fact that vol isn't really picking up. So you're thinking, I don't need to own a load of Vega because it's not doing anything for me. But you can still remain short by owning a naked put spread rather than just a naked put. So that might be one way to monetize some long puts if you have had them in gold. Obviously, I've got a risk reversal on silver that I entered into on the back of owning some silver from lower levels. And I didn't really believe silver was just going to rally. I thought it was probably going to come back down again. So I thought, keep that in the long-term portfolio, but just protect it with a risk reversal. And that risk reversal is now doing okay and has made some money on the way down. I haven't really touched that. I'm kind of keeping that in place because, like I say, it's sitting against my long delta position in the long end book, in the long-term book. So nothing to do. If I feel like silver and gold have capitulated and have done enough to the downside, I'll unwind my risk reversal on silver and maybe even buy some more delta for the long-term book. But right now, I'm not doing anything with that position. Yeah. And then, in terms of what's really keeping a lid on gold, well, inflation expectations are dropping and real yields have been rising. And obviously, we had a relatively strong dollar as well. that's not a great mix for gold bulls, right? So if you could think those trends continue, and personally, I do think they continue, then, you know, that's why I'm still relatively bearish on gold, right? I'm not in the bull camp yet. Longer term, we know when the Fed finally pivots, gold, crypto, they're all going to rally. But in the short term, absolutely no reason to own gold in my mind, right? Okay, thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.